Hello everyone, our topic today is percentage of sales forecasting. Let's jump right into it. So we have two key objectives when we get to the end of this lecture. We want to be able to forecast an income statement and we want to be able to forecast a balance sheet as well. Let's, as we always do, try to motivate the subject a little bit. So why is forecasting so important? Why is it that we would want to have the skills to be able to forecast an income statement and a balance sheet? Well, hopefully everyone can see that forecasting certainly provides a host of benefits. Among those benefits are the ability to project sales and revenue. If you can project sales or revenue, which are essentially the same thing, if you can project that, then you should be able to get some insights on a lot of other really important issues as you peer into the future and try to plan for the needs of your business. Specifically, you should have some idea of what your marketing and advertising needs are in order to hit those sales projections. You also should have an idea about what your hiring and staffing needs are, again, for the purpose of achieving those sales projections. You also should get some insights about your inventory and raw materials needs. Certainly, if you can accurately predict what your sales are going to be, that should give you information regarding the levels of inventory that you're going to need in order to do that. Similarly, you should get some insights on working capital needs. What will your accounts receivable look like? What will your cash look like? Another very important line item about which you should get some information if you accurately engage in forecasting is your property, plant, and equipment needs. You're going to have some idea of what your asset needs are in order to create that inventory or those raw materials in order to hit the sales numbers. And then also very, very important, being able to accurately forecast should tell you what sort of funding needs you're going to have. So are you going to need to go out and raise capital? The sooner you know that, the better situated you will be, because raising capital can be challenging. And there are also a number of other benefits. So just in and of itself, there are benefits to be had from the forecasting process. But more to the point, I want to show you how forecasting fits into the narrative of our class. So we've already said finance is the optimal allocation of scarce financial resources, broken into three subcategories: procurement, deployment, and distribution. We broke optimal deployment into three subcategories: operational efficiency, the go, no-go decision, and asset purchases and sales. We said that when you're trying to make a go, no-go decision, or when you're trying to purchase or sell assets, what you're really trying to do is pin down a value. You're trying to lock down a value for an investment proposition or for a specific asset. So we talked about valuation. We said that the value of any asset or investment proposition should be a function of the utility that it provides. We said that financial assets only provide one type of utility, that's future cash flows. We said that free cash flows to the firm are the specific type of cash flows that we're looking at when we're talking about the utility of financial assets. So in other words, the value of a financial asset and whether or not you will go or no go, and whether or not you will buy or sell an asset, it's going to boil down to the value, which is going to be driven by the free cash flows to the firm. But we're talking about free cash flows in the future. Well, if we remind ourselves of how we calculate free cash flows to the firm, we remember that free cash flows are operating cash flows minus net capital spending minus any increases in net working capital. That's the upper part of the chart here. We can also remind ourselves that the reason that they're called free cash flows to the firm is because these are the cash flows that are left over after we sell our goods and services, reinvest in the net fixed assets of our business, and improve the liquidity or solvency position of our business. Those are the net cash flows that are left over that are free to be distributed to our creditors and our shareholders. And so that's what we're showing in the bottom identity. So what we're saying is, if you want to value an investment proposition, or if you want to value an asset of any kind, a financial asset of any kind, it really boils down to being able to forecast those free cash flows to the firm, because that's what's going to drive the value of the asset or the value of the investment proposition. So in order to forecast the free cash flows to the firm, we're going to have to be able to forecast the income statement and the balance sheet, because you can see we're going to need EBIT. We're going to need depreciation. We're going to need taxes. We're going to need net fixed assets. We're going to need net working capital. Those are all going to come from the income statement and the balance sheet. So this is how percentage of sales forecasting fits into our narrative. We need to be able to forecast the balance sheet and the income statement in order to forecast the cash flows, to value the asset, or to get an estimate of the value of the investment proposition that we're thinking about. So let's talk specifically about this method that we're going to use. It's a broadly used method to try to forecast balance sheets and income statements. It's called the percentage of sales method. And I'm just going to walk you through the 8 steps. We'll do a really simple example. I have a couple of other metrics to show you. Then I'm going to walk you through actually doing this with a real world company. And then at the very end, we'll think about some paradigms or some frameworks that we could use to try to forecast the actual sales themselves. So let's jump into the method here. Step 1 in the percentage of sales forecasting method is to simply identify which income statement and balance sheet accounts vary proportional to sales. Now, there is some general guidance on this. On the income statement, we would certainly say that generally speaking, cost of goods sold vary proportional to sales. We would probably also safely say that selling, general, and administrative expenses vary with sales, and there could be others. On the balance sheet, generally speaking, we say that most current assets and most current liabilities vary with sales. Depending on the type of company, we could make an argument that fixed assets or property, plant, and equipment vary with sales. And there may be some other accounts that vary with sales as well. So that's the first step, is you need to just pin down what are the line items on both the income statement and the balance sheet that vary proportional to sales. The second step is for each account that you identify in step 1, you need to go and calculate that account's value as a percentage of sales on the past financial statements. So if you believe that cost of goods sold varies with sales, then the second step would be to go and calculate that account as a percentage of sales in the past year's financial statements. The third step is to go ahead and project the sales volume and the price. In short, we're saying estimate the revenues for the forecast year. And I'll have more to say about that at the end of this lecture. Step 4 is you need to estimate the value for each account identified in step 1 for the forecast year by multiplying the forecasted sales that you came up with in step 3 by that specific account's percentage of sales in past years, which you calculated in step 2. I know that sounds like a mouthful. It's really not that hard. When you see the simple example, I think it will all make sense. Step 5, judgmentally estimate the income statement and balance sheet accounts that do not vary proportional to sales. So there will be several line items on both the income statement and the balance sheet that don't vary with sales, and we're going to have to just use our intuition and our judgment to come up with reasonable forecasts for those accounts. Step 6 is to calculate external funds needed or projected surplus. In short, what's going to happen is when you go through this exercise, steps 1 through 5, your balance sheet will not balance. More often than not, what's going to happen is you'll have more assets than you have liabilities and owner's equity. If you have more assets than liabilities and owner's equity on your forecasted balance sheet, then you have a shortage of funding. You're going to have external funds needed. If, however, you experience that rare circumstance where you actually have fewer assets forecasted than you have liabilities or equity, then that would be a surplus. Well, we need to make the balance sheet balance on our forecasted financial statement. So step number 7 is you're going to have to determine an account on the balance sheet that will become your plug variable. Typically, the plug variable is either dividends or debt, and we'll talk through that when we go through our example. The last step then is to use whatever you've identified as your plug variable to bring the financial statements into alignment and balance your balance sheet. Okay, so I want to take you and show you a very simple example, just walk you through these 8 steps. I think as we go through it, the 8 steps will start to make a lot of sense. So here is our simplified example. You can ignore these things for now. We'll talk about those in a second. What I've done is I've created a fictitious company, and I'm showing you last year's financial statements. So you can see over here is the income statement, $42,500 of sales, costs of $40,000. which gives taxable income of $2,500. I'm going to apply a 34% tax rate, which is taxes of $850. That leaves us with net income of $1,650, and then we're going to assume a 10% dividend payout ratio, which means 10% of the net income will get paid out in the form of dividends. That means the rest of the net income is going to go to retained earnings. On the balance sheet, again, this is fictitious. I've tried to really boil this down to a very simple example. We just have current assets of $10,000, net fixed assets of $30,000, which gives us total assets of $40,000. Current liabilities on the right-hand side of $4,000, long-term debt of $22,000 on the right side, owner's equity of $14,000, and so we can see that the balance sheet here balances. Well, let's start walking through our steps. So you can see step 1 is to identify the accounts that vary proportional to sales. And I should add, please understand what we're trying to accomplish. I'm giving you last year's financial statements. What we're trying to do is peek ahead 1 year and create the financial statements for next year so that then we can estimate free cash flows to the firm for next year. So step 1 is simply to identify accounts that we believe vary proportional to sales. I've marked these in yellow. So I'm going to say that costs vary proportional to sales. Almost always current assets vary proportional to sales. I'm going to go ahead and say for our simplified example that the net fixed assets also vary with sales. Again, that can be debatable depending on the type of company you're looking at. I'm also going to say that current liabilities vary proportional with sales. So okay, that's step 1. Step 2 is calculate each account's percentage of sales in the most recent year. So I have this past year's financial statements. I'm going to take costs, $40,000, and divide it by sales, $42,500, and what we discover is that costs comprised 94% of sales in this past year. I'm going to do the same thing for current assets. $10,000 divided by $42,500, that gives me 24%. So current assets were 24% of sales in this past year. I do that same thing for all of the accounts in yellow. I just divide them by sales in the most recent year. So what I can see is costs were 94%, current assets 24%, net fixed assets 71%, and current liabilities 9% of sales. Okay, so that's steps 1 and 2. Let's move on to steps 3, 4, 5, and 6. Step 3 is to project sales volume. Again, I'm going to have more to say about this at the end of this lecture. For now, just so I can demonstrate the steps, I want us to assume that sales are simply going to increase by 10%. So you can see I've got a growth rate of 10% here, so I just grow my sales. Previously it was $42,500. Growing it at 10%, that's going to make sales $46,750. Step 4, estimate the value of each account that we identified in step 1. And the way that we do that is we know that costs are 94% of sales. So what we will do is we will take 94% of our new sales forecast, and that will give us $44,000. We know that current assets in the previous year were 24% of sales. So we will take 24% of our sales forecast. That will get us to $11,000. We'll take 71% of the sales forecast. That will get us our net fixed assets. And we'll take 9% of the sales forecast, and that will get us our current liabilities. Okay, so that's step 4. Step 5 is to judgmentally estimate the other accounts. Well, for simplicity, there are really no other accounts for us to deal with. I mean, up here we said that long-term debt and owner's equity were not going to vary with sales, and we said that taxes were going to be 34% of net income. So those are really the only other accounts, but we're not judgmentally going to estimate those. All we're going to say is, okay, the tax rate's going to stay at 34%, and for now, let's just leave long-term debt even, and let's just add whatever the portion is of net income that's not going out in dividends. Let's add that to retained earnings. So, okay, step 5, we're just going to estimate taxes using the 34% tax rate. That's going to get us to net income. We're going to keep a dividend payout ratio of 10%, which means $181.50 of dividends. The rest of net income is going to be added to our owner's equity. You can see that previously it was $14,000. Now we're adding this $1,633. So we've got our new owner's equity and we're leaving debt constant. So okay, there's step 5. We've judgmentally estimated the other accounts. Now, when we go to a real world example, that's going to get more complicated, but I want to keep it simple here. Step number 6 is to calculate the external funds needed. What we said is when you go through steps 1 through 5, your balance sheet won't balance. You can see that our total assets are $44,000. Our total liabilities and equity are $42,34. So what does that mean? We have more assets than we have liabilities and equity. We have more assets than we have funding. Therefore, we have external funds needed. If we want to try to execute this strategy and try to realize these forecasts, we need to come up with funding of $1,966.50. Okay, that moves us to the next step, which is to determine a plug variable. You can either use dividends or you can use debt. Those are the two most common plug variables that are used. Dividends in this case won't really get the job done. We need $1,966.50. The best we could do with dividends is not pay any at all, and that only gets us an extra $181.50. We're going to go ahead and use long-term debt as our plug variable. So that means getting us into step 8 is use the plug variable to bring the financial statements into alignment. We're just going to add $1,966.50 to our long-term debt. You can see I've done that right here. And by doing that, we actually find ourselves with a balance sheet that balances. And here are our pro forma, or our forecasted financial statements. So that's just a really simple example to walk you through the steps that we just went through. What I'd like to do now is introduce you to just a couple of important metrics when it comes to measuring how quickly our company can grow. There are two of these. The first one is called the internal growth rate. The second one will be called the sustainable growth rate. Let me just give you the definitions and the formulas, and then I'll show you real quickly how to calculate them. The internal growth rate is the maximum growth rate at which a firm can grow using only internal funding sources. So this is the fastest rate at which a company can grow if they're not going to take on debt and they're not going to issue equity. The second metric is called the sustainable growth rate. It's slightly different. This is the maximum rate at which a firm can grow using only internal funding and debt while keeping its capital structure constant. And capital structure is the mix of debt to equity. So the sustainable growth rate tells you how fast you could grow if you use your retained earnings and debt and you're trying to keep your capital structure the same. So in other words, that's the fastest you can grow at without messing up your balance sheet if you're not going to issue stock. Here's how you calculate these two metrics. For the internal growth rate, it's ROA times the plowback rate over 1 minus the product that we just calculated in the numerator. So ROA times plowback rate over 1 minus ROA times plowback rate. For sustainable growth rate, it's return on equity times plowback rate over 1 minus return on equity times plowback rate. So they're very similar. The only difference is sustainable growth rate uses ROE, internal growth rate uses ROA. Remember, B stands for plowback rate, which is 1 minus the dividend payout ratio. It's not a hard concept. B simply represents the percentage of net income going to retained earnings. That's all it is. So we can go back to our simple example that we used here, and you don't want to calculate this on a forecasted basis. You want to calculate sustainable and growth rates based on the past year's data. So using the past year's data for our Scandia Mining Company, I've calculated ROA. Remember, that's just net income over total assets. I've calculated ROE. That's just net income over total equity. I've calculated the dividend payout ratio. It's 10%. That means that our plowback rate is 90%. Remember, plowback rate is just the percentage of net income going into retained earnings. So to calculate our internal growth rate, we would just use this formula right here. ROA times the plowback rate over 1 minus ROA times the plowback rate. So it would simply be ROA times the plowback rate and then divide it by 1 minus that. When I do that, I get 3.86%. The sustainable growth rate is almost the same. You just replace ROA with ROE, and I get 11.87%. That number right there is informative. It tells you that we're not going to be able to handle this growth with internal funding. If we predict that sales, which we said down here, if we predict that sales are going to grow at 10%, that's beyond our internal growth rate, which we calculated at 3.86%. That right there, just looking at the internal growth rate and our predicted growth in sales, that tells us we're going to have external funds needed. We're going to have to raise some external sources of funds. All right, let me make a few key points, then I want to walk you through a real-world example of percentage of sales forecasting. First key point, how to determine which accounts vary with sales. A lot of people get really worked up. They start looking at balance sheets and income statements, and they're just not sure whether or not this particular line item varies proportional to sales. Well, I would say first off, what does your intuition tell you? When you look at a specific line item, does your intuition tell you that this is something that should vary with sales, or does it tell you that it's something that might not vary with sales? If you're not sure, if your intuition tells you it could go either way, go ahead and look at empirical data. What I mean by that is look at 3 or 4 years worth of past data. If you go and look at 3 and 4 and 5 years worth of past data, and you see that in fact this account is very stable as a percentage of sales, you can probably be comfortable moving forward with the assumption that it does vary with sales. If you go and look at 4 and 5 years of past data and you see a lot of volatility in that account as a percentage of sales, you might be less confident moving forward with the assumption that it will vary proportional to sales. Another key point, the sales forecast drives everything. If you get the sales forecast wrong using the percentage of sales method, everything else is going to be wrong, which is why, again, I'll have more to say about that before we finish this video. Lastly, don't forget the sanity checks. Is your sales forecast reasonable? Does the trend that you're predicting in expenses seem reasonable? Given your sales and expense forecasts, when you look at the balance sheet, do the assets seem sufficient? If you have external funds needed, if there's a shortage, how reasonable is your proposed funding plan? Always, always, always put your numbers through your sanity checks. At this point, I'd like to actually go and pull up a real-world company and walk you through how to do percentage of sales forecasting with that company. And I'm going to use Target as our company. So the latest financial statements that I have for Target are for the period ending January 31st, 2015. So I'm going to go ahead and engage in pro forma forecasting for the period ending February 2016. As I look at the past 4 years worth of financial statements, here's the income statement. Here is my balance sheet. I only have 3 years for the balance sheet. Remember, step number 1 is to identify which accounts vary with sales. Well, let me point out real quickly, Target's gone through some changes. They used to have a credit card division. They sold that off. That's why in the most recent 2 years that I have, there's no credit card revenue. So they're pretty much just back to their strict sales from their stores. Well, let's look at these accounts below the total revenue and see which ones we think vary with sales. I'm going to go ahead and say that cost of sales will vary proportional to sales, so I've highlighted this in yellow. I'm going to say that SG&A vary proportional to sales, so I've highlighted that in yellow. I'm going to say, however, that depreciation and amortization do not vary with sales, and I'm going to assume that this gain on receivables transaction will be 0 moving forward, just like it was last year. EBIT will simply be a calculation. Net interest expense, I do not believe will vary proportional with sales. I believe that will vary more with our debt and our interest levels. Earnings before income taxes is simply a calculation. Provision for income taxes, we're going to try to just apply the right tax rate for that, and then that'll get us to net earnings. I am going to assume a constant dividend payout ratio. In the most recent year, their dividend payout ratio was 37.54%. So dividends are not going to vary with sales. We're just going to keep a constant dividend payout ratio. On the balance sheet, I'm going to assume that all current asset accounts vary with sales, so those are yellow. I'm going to assume that for Target, their land, building, fixtures, computer hardware, construction in progress all vary with sales. Now, this is where we get into that gray area. Do we really believe that the fixed assets of Target vary proportional to sales? My intuition tells me that I think that's right, because I think they need fixed assets, they need stores, they need land, they need buildings, they need fixtures and equipment in order to actually sell their products. But I'm also going to look at the empirics. And what it looks like is over the last 3 years, these things are a relatively stable percentage of sales. Now, I've skipped ahead a little bit, but I'm just using those empirics to try to validate my intuition that it's okay to have these vary with sales. Accumulated depreciation, however, I'm not going to have vary directly with sales. I'll show you how we'll attack that in a minute. Other non-current assets, I am going to assume vary proportional with sales. Okay, on the liability side, I'm going to assume that accounts payable and accrued and other current liabilities both vary with sales. The current portion of long-term debt and other borrowings, I don't believe will vary proportional with sales. We'll have to attack that with a different method. The liabilities of discontinued operations certainly wouldn't vary with sales, so that's not going to be highlighted in yellow. Okay, long-term debt is going to be my plug variable. So I'm going to come back to that one. I am going to assume that deferred income taxes will vary proportional with sales. That's mostly based on empirical data. You can see that it's been very constant as a percentage of sales. Okay, non-current liabilities of discontinued operations, I'm not going to assume will vary with sales. We'll come back to that. Other non-current liabilities I will have vary with sales, and you can see that's largely owing to the empirical evidence that I see here. Stockholders' equity, I'm not going to have any of this vary proportional to sales, so we'll talk about all of that. So, okay, that's step one. I've identified the accounts that I think will vary proportional to sales. Step two is to calculate each of those accounts as a percentage of sales using past data. You can see I've done that on the income statement for the last 4 years. So there's my cost of goods sold as a percentage of sales. There's SG&A as a percentage of sales. I do the same on the balance sheet. So for all of the yellow accounts, I've highlighted their percentage of sales over the last 3 years. Step number 3 is to go ahead and forecast our sales. Now, for now, I'm going to assume that target sales are going to grow at 2.1%. We can talk later about how I got that, but like I said, I really want to wait till the end of the video to talk about how we can think about forecasting sales. So for now, please just accept my forecasted sales growth of 2.1%. If sales are going to grow at 2.1%, then that means we think sales will go from 72.6 billion up to 74.1 billion. All right, step number 4 is to go ahead and forecast the accounts that we identified in step 1 that we believe will vary proportional to sales. For cost of goods sold, you can see what I'm doing here is I'm taking our forecasted sales and I'm multiplying it by the percentage of sales that the cost of goods sold were in the most recent year. Now, there is some debate. Should I take forecasted sales times the most recent percentage of sales for cost of goods sold or times an average? I really think it depends on the account. Empirically, when I look at these accounts, I see somewhat of an upward trend. So I think if I took the average, it would actually underestimate my cost of goods sold. So I'm going to go with this most recent point estimate of cost of goods sold as a percentage of sales. Okay, for SG&A, I do the same thing. I take the most recent percentage of sales, which is over here in J9, and I multiply it by our forecast of sales. Those are the only 2 accounts on the income statement that I believe are going to vary with sales. I come to the balance sheet and I start doing the same thing. You can see right here I take the most, and this is for cash and cash equivalents, I take the most recent percentage of sales and I multiply that against my forecasted sales on the balance sheet. So I hope you can see the trend. I do that for all of the accounts on my balance sheet. Now there may be 1 or 2 where I actually take the average, but for the most part I'm using the most recent point estimate. So okay, I believe that's step 4. I have now estimated all of the accounts that I believe are going to vary proportional to sales. So I've done that for both the income statement and the balance sheet. Now what we need to start doing is we need to start working through how we're going to estimate each of these accounts that are highlighted in green that I don't think will vary proportional to sales. So first, let's tackle depreciation and amortization. What I've said here, and I've got a note, is I'm going to assume that this is a constant percentage of gross fixed assets. So what I've calculated here, these numbers are not depreciation as a percentage of sales. They are depreciation as a percentage of gross fixed assets excluding land. So how am I going to forecast depreciation expense on our income statement? I'm going to come to the balance sheet. I'm going to look at our forecast for assets excluding land. I'm going to add up my gross fixed assets, again excluding land. I'm going to take that number and I'm going to multiply it by this percentage, 6.09%, which again represents in the previous year what depreciation and amortization was as a percentage of gross fixed assets. For my net interest expense, and we run into a little bit of a problem here because it gets a little bit circular, but let me tell you my reasoning as to how we're going to estimate interest expense. What we're going to do is we're going to figure out what is the average interest rate on all of our debt, and then we're going to estimate what our debt is. Now remember, that's going to be a little bit circular because debt is going to be our plug figure on the balance sheet. But what we're doing theoretically is we're going to figure out an interest rate and we're going to apply that against our forecasted debt on the balance sheet. Where would we go to find information about the right interest rate and how much debt Target is going to have in these next few years? Well, if you go to the balance sheet, so go to the SEC website, and if you look here to the side, they have notes to the financial statements. Every company that has long-term debt will have a footnote about that long-term debt. So if you go right here to notes payable and long-term debt, some really helpful information is going to pull up. Here's the first piece of helpful information. It shows you all of the maturities of their long-term debt, and it shows you what the weighted average interest rate is. It also shows you what the required principal payments will be in each of the next 5 years. So what I've done is I've created a tab that has all of that information. I'm going to take that 5% and I'm going to record that on my income statement. So here's my 5% right here. Now again, we said debt was going to be a plug figure on the balance sheet, so we've still got to tinker with that a little bit, but whatever our debt ends up being, we're just going to apply 5% against that, and that will give us our interest expense. I'd also like you to notice, however, this information is also extremely helpful for us when we forecast the balance sheet. As we step out 1 year, so we're trying to forecast the balance sheet at the end of this 2016 period, what that means is looking forward in that year, we will have $751 million of long-term debt that we'll have to pay in that period. So you have to understand the timing here. These companies have fiscal year ends, most of these big box retailers, January 31st. So the most recent financial statements that I have are for the period ending January 31st, 2015. I'm trying to forecast the period ending January 31st, 2016. This is how much debt they're going to have to pay in the year 2016. So as of January 31st, 2016, that's a pretty good estimate for the current portion of long-term debt. So I'm going to come to my balance sheet, and for my current portion of long-term debt, which is right here, I'm going to put in that 751 that we got from that footnote. Okay, so two important things came from this. 5% interest rate and 751 is the current portion of long-term debt. How are we going to get the long-term portion of long-term debt? Well, that's going to be our plug variable, and we'll talk about that in just a second. So once we have our long-term portion of long-term debt, that will automatically be able to calculate. Provision for income taxes, I said we were going to just apply a constant rate. Again, if you go back to the footnotes to the financial statements, you can see that all companies have a footnote on income taxes. As I scroll down, you can see that in the most recent year, the effective or the average tax rate was 33%. So I'm going to roll forward with that. We could again talk about whether or not we should use 33% or an average of the last 3 years. I believe in this instance it's more accurate to use the most recent year because it's more likely that that most recent year is going to be the best representation of what the tax structure looks like moving forward. So I'm going to apply a 33% rate. And again, I'm going to keep my dividend payout ratio constant. Some of this other stuff just gets calculated, right? EBIT just gets calculated. That's just going to be my revenue minus all of my costs. And then I'm going to take out my net interest expense, which we couldn't quite calculate because we don't have our long-term debt yet. When I take out my interest, that's just going to give us earnings before taxes. We're going to apply our 33% tax rate to get our tax provision. subtract that out and we get net income. Apply our 37.54% dividend payout ratio, and that gives us dividends. What's left over from net income that's not being paid out will go to retained earnings. So we've got our income statement figured out. We just need to get that debt figure. And I think I've already said this. I've already put the formula in here. So all I've got to do is get debt, and it will automatically be the right interest expense. So let's go to the balance sheet. All right. The first green account that's not varying with sales is accumulated depreciation. I want you to notice that accumulated depreciation has been going up by about $1 billion every year. So it hasn't really been moving with sales, is what I would say. And it hasn't necessarily been moving with depreciation expense. If you notice, in the period ending January 31st, 2015, depreciation expense was $2 billion. But accumulated depreciation only went up by about $1 billion. That tells me if you think about accumulated depreciation as a bucket, there is depreciation going in each year in the form of depreciation expense, but there's also depreciation expense being pulled out in the form of asset divestitures or asset retirements. So the way I thought about this was, let's look at last year and let's ask ourselves, what percentage of this depreciation and amortization actually went into accumulated depreciation? The answer is 49%. So what I said is, let's take 49% of our forecasted depreciation and amortization, which is this $2,174 million. Let's take 49% of that and put that much into our accumulated depreciation. So that's how I go from $15.1 billion to $16.16 billion, is I simply added 49% of our forecasted depreciation and amortization expense. Once we have that, we actually have all of the assets on the balance sheet, so we're halfway there on the balance sheet. We said that the current portion of long-term debt, we would not use percentage of sales. I already told you how I got that one. We got that from the footnote for long-term debt. Liabilities of discontinued operations, I just left it constant. I hesitate to say this, but it's such a small number, I'm going to consider it immaterial, so I would either keep it constant or make it 0. Long-term debt is going to be our plug variable. We already did deferred income taxes. Non-current liabilities of discontinued operations, well, I kept the current liabilities of discontinued operations constant, so I just did the same thing for non-current liabilities of discontinued operations. Those might not be great assumptions. Frankly, that probably got retired this year, and some of this should shift into current portion, but I think we're safe just leaving it constant. They're not very big numbers. Okay, so we're getting very close because now we almost have the liabilities. We just need to figure out this total debt, which is going to be our plug number. Okay, on common stock and shareholders' equity, I just decided to leave common stock constant at 53, and I left APIC constant as well. Now, APIC is going up, it's trending up, so we may want to rethink that. We may want to trend it up by whatever the trend has been in the past years, but for now I left it constant. Retained earnings, the way that I got 11,316 is to take the last retained earnings and add whatever part of our forecasted net income right here is going to retained earnings. Remember, 37% is being paid in dividends. The rest is going to retained earnings. So I just took that number from the income statement and I added it to retained earnings to get our new retained earnings. I left our pension liability constant. I left the currency translation adjustment constant. Everything else is just numbers that we would add up, right? We would add up, for instance, all of these debt figures to get total non-current liabilities. We would add up all of these equity accounts to get total shareholder investment. And we would add up the total current liabilities, total non-current liabilities, and total shareholders investment to get our total liabilities and shareholders investment. Well, when I do that, you can see that our balance sheet does not balance. You can see, in fact, that we have $46.8 billion of assets. We only have $43 billion of liabilities and shareholders' equity. So what does that mean for us? That means that we have external funds needed. I decided to use debt as my plug figure. So I'm going to come in here and show you how to do iterative calculations. The problem is you can't just try to do a simple formula to make this balance because you're going to get a circular reference going. When you change that number, debt, it's also going to change your interest expense on your income statement because your interest expense is based on your debt. When you change your interest expense, that's going to change your net income, which will change your addition to retained earnings, which will change your retained earnings on your balance sheet. So hopefully you can see the circular reference problem that you get into. So what I'm going to do is I'm going to hard code in a number for long-term debt. I just hard coded in that number. And what you have to do is go to File, Options, Formulas, and you have to click Enable Iterative Calculation and click OK. Now what we're going to do is we're going to use Goal Seek. So I'm going to go to Data, What If Analysis, and Goal Seek. And what I'm going to say is set this cell, 43156, equal to our total assets, which is 46849, by changing the long-term debt. So what I'm telling Excel to do is make total liabilities and shareholder investment equal to 46849 by changing the long-term debt. Hit the enter button and it does a whole bunch of calculations, and you can see that we arrive at this debt figure of 15,699. You can see that that did change our interest, right? So our net interest expense went up. That lowered our net income, which lowered our addition to retained earnings, but it all balances. What does that mean, however? That means that in order to fund this growth, we're going to need to increase our long-term debt by $2.99 billion. That's non-trivial. You can see in the previous year they increased their long-term debt by $1.3 billion. Increasing it by another $2.9 billion is going to take some work. So we may want to think about some other options. Maybe we can't grow this fast. Maybe we want to pay less dividends. We might want to think about issuing stock. So we might want to think about how we're going to fund this growth. But I hope that gives you a nice real-world example of how you can think about doing percentage of sales forecasting. All right, so we just walked through what I hope was a helpful real-world demonstration of percentage of sales forecasting. What I'd like to do now is just point out the keys to success with percentage of sales forecasting. In other words, in order for this method to work for you, you got to get these things right. First and foremost, you have to accurately forecast the sales. If the sales forecast is off, nothing else will be right. The second key is you have to accurately pin down which balance sheet and income statement accounts actually vary with sales. The last key to success with percentage of sales forecasting is having good intuition and good empirical data to help you forecast those other accounts that don't vary with sales. As an example, remind yourselves of how we forecasted, for instance, depreciation and amortization. How did we forecast net interest expense? Right? These are the types of accounts that don't vary with sales, and you have to be good in your intuition and your data in order to make this method work. Well, again, if the sales forecast is off, the whole thing blows up. So I want to spend just a few minutes here at the end talking about ways you can think about forecasting sales. Let me give you a caveat. I do not believe that there is one foolproof method that will get you to an accurate sales forecast. I think you have to use your acumen regarding the macroeconomy, the industry, and the company that you're looking at. You have to use good solid intuition, and you have to use good empirics. But let me just give you some ways you could think about forecasting sales. One way is called the top-down method for forecasting sales. In the top-down method, you start by forecasting the macroeconomy. Is the macroeconomy going to grow at 3%, 2%, 1%, 4%? The next step is from your forecast of the macroeconomy, you go ahead and forecast the industry that you're analyzing. Once you've forecasted the industry that you're analyzing, so for instance, what will the total sales be in this industry now that we know what the economy is going to look like? The last step in a top-down forecasting method is to ask yourself what percentage of those industry sales or what percentage of market share will this company attain? So a nice example of top-down forecasting might be auto manufacturers. They might start by forecasting the macroeconomy in the major locations where they sell vehicles. So if I'm Ford Motor Company, I might say, what do I think China's economy is going to be? What do I think Brazil's economy is going to be? What do I think the Eurozone's economy is going to be? And what do I think the US economy is going to be? So, okay, we pin down those economic forecasts. The next thing we would do is we'd say, okay, now that we know what the economy is going to look like, we can get a pretty good estimate using past data of what the total sales of sedans are going to be in all of those various economies. So you go and estimate all sales of all sedans in China, Brazil, Eurozone, and America. The last thing you do is you say, all right, we have a pretty good guess of what our market share is going to be in China. We have a pretty good guess of what our market share is going to be in America, the Eurozone, and Brazil. We know what the total industry sales are going to be for sedans. So we just multiply our market share by that forecast of industry sales. So that'd be an example of top-down forecasting. The opposite would be called bottom-up forecasting. So here's how to think about bottom-up forecasting. First thing you do is identify what your company's various revenue streams and business lines are. Next, break it down into important geographic regions. Once you've done that, you go query customers, query your sales force, query your managers to estimate the sales by product and region. Lastly, aggregate those regional product forecasts to create a firm-wide sales forecast. So what might be a nice example of this? Let's say that you make safes. There are several companies here in Utah that design safes for guns and for protecting personal items. So one thing you might do is you might say, okay, what are the various safes that we sell? Figure that out. And you might say, all right, where are the regions that we sell all these things? And you might have America, and maybe only you sell in America, so you might have it broken up into 8 regions. So what you would do is you would go and query your managers and your salespeople, who then might query customers in those 8 regions, and you would get reports back saying, all right, in the Southwest, for these 3 types of safes, this is what we forecast our sales to be. And then what you would do is you would aggregate all of those regional safe forecasts for your various types of safes, and that would give you your firm-wide sales. So these are sort of 2 opposite ends of the spectrum when it comes to frameworks for thinking about how to forecast sales. Let me give you sort of an alternative paradigm. It's a little bit of a blend, probably has a little bit more to do with the top-down approach. So some people think of it this way. Maybe the first thing you should do in forecasting sales is ask yourself, what are the drivers of sales? In other words, what are the factors that really influence the sales of our product, of our goods and services? And this is a conceptual and intuitive exercise. And so maybe you write down 5 or 7 variables that you think really do have a heavy influence on how much you sell your product. The next thing you would do is actually go and get data and test your intuition and see empirically which of those drivers are the true fundamental variables that really influence your sales. The third step is, once you've identified which ones are the true drivers, you want to empirically define that relation between your revenue drivers and your revenue. Once you've empirically defined very clearly what that relation is, then you go and get some macroeconomists to help you forecast your drivers. And if you already know the relation between the drivers and your revenue, and you know what your forecast is for the drivers, then you can go ahead and forecast your revenues. So I thought we would look at an example using Exxon Mobil. So let's think about this for just a second. If we want to identify the potential revenue drivers conceptually. So Exxon Mobil, for the most part, explores for and extracts oil from the earth, refines it, and then sells it to users. So what do we think would be sort of the drivers of their revenue numbers? Well, certainly I think we would all agree oil prices. Clearly, whatever the price is of the good that we're pulling out of the ground and selling to people, that's going to matter. We might also think that maybe the state of the macroeconomy matters. Maybe when we're in economic expansions, people are more likely to use energy, more likely to take trips and buy gas for their cars, more likely to keep their homes a little warm during the winter and cooler during the summer. So, okay, maybe the macroeconomy, maybe inflation has a factor. So we could keep going down the list, but let's just grab 3 for now to try to walk through this example. So I'm going to grab oil prices, I'm going to grab inflation data, and I'm going to grab GDP data. So what I've done over here is I've grabbed a whole bunch of data, Make that as big as I can. So here are earnings for ExxonMobil going back to 1991, 116 billion. You can see in 2014 they had almost 412 billion. I've grabbed oil prices per barrel going back to 1986 when it was $15 a barrel. In 2014 it was $93 a barrel. I've grabbed CPI data. This is to tell me what's going on with inflation. I've grabbed GDP data. You can see that in 1986 GDP was 4.5 trillion and the most recent reading in 2014 was 17.3 trillion. What I really want to do though is figure out what's my guess for the growth in ExxonMobil earnings. This is something that's far beyond the scope of this class, but it turns out that you get cleaner statistics when you're looking at deltas as opposed to levels. So we don't want to look at the relation between these levels. For instance, what was ExxonMobil's earnings compared to oil prices? What we want to look at is what is the change in ExxonMobil's earnings relative to the change in oil prices. So all I've done here is calculated a bunch of deltas and done some time shifting. So here's the change in ExxonMobil's earnings from 1991 to 92, 92 to 93, 93 to 94, and so on. Here's the change in oil from 91 to 92, 92 to 93. Okay, and then I just did some time shifting. So right here, I've calculated the change in ExxonMobil's earnings from 92 to 93. This represents the change in oil in the previous year. This is the change in oil the next year. So that's T minus 1 is the year before, T plus 1 is the year after. So it's just some time shifting. The only reason I'm doing that is you never know where the correlation might be. The correlation is not always contemporaneous. Sometimes the driver moves and then the earnings move. In that case, what you would see is that the change in ExxonMobil earnings correlates with the year before delta in oil. That's the only reason I'm doing some time shifting here. I've calculated CPI contemporaneous. So this is inflation contemporaneous with ExxonMobil earnings. This is inflation 1 year before, inflation 1 year after. This is GDP growth contemporaneous with ExxonMobil earnings. GDP growth 1 year before, GDP growth 1 year after. Well, remember, next step is we want to empirically determine what the true drivers are. So what I did is I calculated the correlation matrix. Let me make this as big as I can so we can see it. Now remember, I'm using the simple Pearson correlation coefficient. These are bivariate correlations. They're bounded by -1 and 1. Perfect positive correlation is 1. That means that two data streams move in perfect tandem. Perfect inverse correlation is -1. That would mean that two data trends go in opposite directions. If there is no correlation, then it would be 0 for the correlation coefficient. So this is the column we want to focus on. ExxonMobil earnings, the delta in ExxonMobil earnings relative to these other potential drivers. There's good news here. ExxonMobil's earnings don't really seem to be correlated with any of the time shifts. T minus 1, T plus 1, T minus 1, T plus 1. All of the time shifts have pretty low or negative correlations. However, the contemporaneous change in oil prices has a pretty positive correlation with ExxonMobil earnings. We thought that would be the case. Inflation also has pretty positive correlation, as does growth in GDP. So from simple correlation analysis, it looks as though all three of our drivers contemporaneously might be driving the delta in ExxonMobil's earnings growth. So what I did is I got rid of all of the time shifts. So I dropped out my T minus 1 and T plus 1s. And now I just have my data contemporaneous. So there's the change in ExxonMobil's earnings. There's delta oil, inflation, and delta GDP. What I did after this is I calculated a regression. What a regression does is it draws a scatter plot. Okay, so what I've done is I've created a simple scatter plot. And what I've done is for each of these data points right here, I've simply mapped out these two things. So for instance, on the x-axis, I found negative 4.56%, and on a y-axis, I found 0.53%, and I painted a dot. And for this one, I found negative 11.03% on the x-axis, and negative 5.17% on the y-axis. So I simply created a scatter plot by mapping out all of those data points, what regression does is tries to draw a line through this. Now, you might be a little confused as to why we would do this. Well, maybe you remember from your math class back in high school that when you have two variables, when you have a dependent and an independent variable, and you want to try to identify the linear relationship between these two variables, we use the equation y equals mx plus b. Remember, that's just the equation for a straight line, and all it says is if you know the value of x, multiply that by the slope coefficient m, and add the y-intercept, and that tells you where you are on the line for the y variable. All regression is trying to do is define a line that will define the delta in Exxon Mobil by the delta in oil. So in other words, the change in oil prices will be the x variable, and the change in Exxon Mobil's earnings will be the y variable. So we're literally just trying to fit a line through this. So we could think of it this way. The delta in Exxon Mobil's earnings in period t is the y variable. The delta in oil is the x variable. We're going to call the slope coefficient a beta. That's just what we do in regression. And we're going to call the y-intercept alpha. But this is nothing more than y equals mx plus b. We're just calling them different things. So we want to try to define a relationship that will tell us if we know what the delta in oil will be, then we could estimate the change in Exxon Mobil. And we're just going to do it this way. Again, we're going to use y equals mx plus b, but I'm going to redefine m as beta. Our x variable will be our delta in oil, and we're going to redefine our y-intercept as alpha. So that's all regression does, and you can actually fit a line through this in Excel. Okay, so what I've done is I've added the trend line in. So here literally is the line. This is the regression line. For those of you that are statistics junkies, the way that you estimate that line is by minimizing the squared vertical distance between the dots and the line. So you use calculus to minimize the squared vertical distance between the dots and the lines, and you come up with a line that, quote, best fits the data. And there are measures of how well this fits the data. I'm not going to get into that. But it actually spits out the equation for you, and it gives it to you in y equals mx plus b format. So what does that tell you? This tells you that if you wanted to forecast Exxon Mobil's earnings, or at least the delta in Exxon Mobil's earnings, just go and get the delta in oil, multiply it by 0.4849, and add 2.4%. So just to try to demonstrate this to you, let's take this equation, y equals 0.4849, y equals 0.4849x plus 0.024, if I remember right. So there's the equation. So what if you wanted to try to estimate the change in Exxon Mobil's earnings, and what if you thought that oil was going to change by 10%? All you would do is take 10% times 0.4849 and add 0.024, which is 2.4%. And there you have it. So your forecast for the delta in Exxon Mobil's earnings for this next year, if you thought the delta in oil was going to be 10%, using this equation for a line, which came from this scatter plot, what you would say is, if I trust that line, then I think if oil increases by 10%, I'm going to see a 7.25% increase in Exxon Mobil's earnings. So again, regression essentially creates a scatter plot where you're trying to use your revenue drivers as your x variable to explain your revenue growth as your y variable by drawing this line and figuring out specifically what the slope and y-intercept are supposed to be. But what I really want to do is run this regression or try to find this equation with two extra x variables. So if beta is my slope coefficient, I want to find a slope for delta oil, a slope for delta CPI, and a slope for delta GDP. So that's what I've done here, is I've found a slope coefficient for oil, a slope coefficient for CPI, and a slope coefficient for GDP. But there's one other thing. Remember, one of the steps that we're talking about is empirically determining the true drivers. Regression helps me to do that because regression gives me a p-value. What the p-value tells me is the statistical significance of these coefficients. Again, I don't want to get into a lot of nuance here. Let me just simply say the lower the p-value, the stronger the statistical significance. So you can see that the p-value on oil is near 0, as is the p-value on GDP. Now forgive me if you have a strong statistics background, you know I'm shortcutting a lot here, but I'm trying to keep it simple. The p-value, however, on delta CPI is actually quite high. The highest that the p-value can get is 1. It's bounded by 0 and 1. Closer to 0 means strong statistical significance. Approaching 1 means it's not statistically significant. So the way to interpret these results is inflation really is not a statistically significant driver of the delta in ExxonMobil's earnings. The two statistically significant drivers are actually oil and GDP. So okay, I feel like I've done this now. I've empirically determined the true drivers. It's oil and GDP. So the next step is I scrubbed my data even a little more. I got rid of CPI and now I just have the delta in ExxonMobil's, the delta in oil, and the delta in GDP, and I ran the regression again. And again, you can see that I've got my coefficients. So I've got my beta 1. Right here is my beta 1. And I've got my beta 3, which is right here. And remember, I cut out CPI, so we don't have a beta 2. So if I was going to write the equation that came from this, my equation would be this. The change in ExxonMobil's earnings equals my intercept, which is minus 10.7%, plus my slope coefficient on oil, which is 0.364, times my change in oil, plus my slope coefficient on GDP, which is 3.096, times my change in GDP. So that's the equation that we've come up with based on the regression analysis, that our change in ExxonMobil earnings is going to be minus 10.7% plus 0.364 times our change in oil plus 3.096 times our change in GDP. At this point, we have now done this. We have empirically determined the relation between the revenue and the key empirical drivers. There it is right there in that equation. The next step is forecast the drivers. Now this is where you need macroeconomists. I'm just going to wave my hands. What if you thought that oil was going to go up by 15% and you thought that GDP was going to grow by 3.5%? If that's what you thought, then we can get our estimated change in ExxonMobil's earnings by using our equation. We would take minus 10.7% plus 0.364 times our forecast of the delta in oil plus 3.096 times our forecast for the change in GDP, and that would actually give us our forecast for what we think the change in ExxonMobil's earnings will be. Now, forgive me, I got us into the weeds there, but I just wanted to give you an example of how to actually use this paradigm for forecasting revenues. And you can see that it is a nice way, it's a nice empirical way, it's not without flaws, but at least it gives you some structure to use when trying to apply your forecast. All right, so I hope that the lecture has been informative for you. I hope that it's been helpful. I hope that walking through the examples of how to do percentage of sales forecasting has been illuminating. Remember, what we're trying to do is forecast income statements and balance sheets so that we can forecast free cash flows to the firm, so that we can value assets, so that we can optimally deploy our capital. I want you to remember you should not look at anything I gave you today as a recipe. You should look at this as a way of thinking about how to approach a problem. So percentage of sales forecasting is a way to think about how to forecast balance sheets and income statements. Top down and bottom up, those are ways to think about forecasting sales. And then I gave you that alternative kind of top-down approach to thinking about how to forecast sales. Showed you how to do it with ExxonMobil. I don't want anybody to feel stressed if you didn't follow that, but I thought some of you might appreciate it. And I will talk to you later.